Hi guys, welcome to the video. Welcome to the webinar. My name is Mark Shawson, the Pattern Trader. So we've got over 200 people now that are registered to this webinar. So fantastic outpouring of support. And so welcome to this live event. So I'm often asked, is this in real time? And this is hopefully as real as a heart attack. This is live. 4-day trade execution webinar series subtitled How to Capitalize on Monster Moves in the Markets. My name again is Mark Shawson, the Pattern Trader. For those of you who don't know me, this is your first time, welcome. What I'm going to talk about over the next 4 days is how I capitalize on monster moves in the markets using just price action and price patterns. So there's two divergent ways of looking at investments. One's called fundamental analysis, where you break apart investments and you look at all of the the metrics and the moving parts. And then there's another school of thought that only looks at price, and I'm in that second camp. So those of you who don't know me, I'm just going to give you a kind of a brief background on my trading journey. I started many moons ago, as you probably can tell, when I was in my late teens. I was in college. I was at one of the best business schools in the country out in Los Angeles. It was the University of Southern California Business School, USC. And I was being schooled in fundamental analysis, how to break apart a company, looking at price earnings and sales turnover and inventory ratios, and looking at the management, what we call fundamental metrics. And right around that same time, my father was doing business with an investment banker. My dad was trying to raise money for a drive-through animal park called Lion Country Safari. It's actually still in existence, even though my dad sold out a long time ago. We have one out here in Florida. But my dad, went to an investment banking firm to raise some money, and he met an investment banker by the name of Graham Loving. And Graham was a very interesting, iconic character. He wore an eye patch over his eyes. His name was Graham Loving. You couldn't kind of make that name up. And by day, Graham was doing his investment banking, and by night he was studying the commodities charts and actively trading the commodity futures markets. Now, this was at a time where, frankly, it's very strangely reminiscent of the times we're going through now. This was in the late 1970s, where you had rampant inflation, oil price spikes. Russia was at war with Afghanistan. So, if it sounds eerily familiar, it's because it is. And so this was really my introduction to trading, right in the late 70s, where Paul Volcker, the chairman of the Federal Reserve, raised interest rates for the first time to 21%. And we had all this kind of turmoil in the markets, inflation and things of that nature. And again, eerily representative and reminiscent of what's going on now. So the thing is, Graham was looking at these exotic commodity futures markets: cocoa, live hogs, orange juice futures, soybean meal, pork bellies, gold, T-bond futures. He was trading about 30 different markets simultaneously. And I was wondering, how in the world could you understand one of those investments and try and make an investment, never mind, 30? And the way he was able to juggle all of this was he was only looking at the price action on those commodity futures charts. So again, this was the time before the internet, before any kind of sophisticated charting. And he would basically go down the corner, stationery store, buy some graph paper, and just plot an X and Y axis. And over time, he would just every day plot the closing price of live hogs or pork bellies or soybean meal or whatever. And he'd say, Mark, I simply want to buy a market that's going up and sell a market that's going down. And to my very simple pea-brain mind, this was, very, this had a lot of resonance for me. And so really captivated me. And so I watched Graham make a boatload of money. In fact, around 1978, 1979, my dad put in 50 grand and Graham put in 450,000. They started this account with $500,000. And by the end of the year, it was $5 million. So, this was at a time where I was very impressionable, where I was kind of looking around what I was going to do with my life. And when I saw, Graham making this monster amount of money, it obviously intrigued me. And I knew that I'd found my passion. And so again, it wasn't just how much Graham was making, it was how he was doing it. And he was just analyzing this price action. He knew nothing about the markets themselves. And so it was from this early tutelage, this early exposure, that I, embarked on this journey to build on my knowledge of price action, price patterns. And I have over time, built an authentic mousetrap that, I understand, that has been based on experience and hard experience. I've made a lot of money and I've blown a lot of money. And so I, think I know the potholes and I know the traps that most people fall into, because I fell into all of those myself. So it was on that basis that I started the Pattern Trader, where I thought I could add value. I saw all of the crap that's being taught out there, all of these expert advisors that, are being sold that, pretend to make you all kinds of money by just loading some technology on your, MetaTrader platform, and on you're going to go. It's just going to trade for you ad infinitum. And, I don't know how that makes sense to anybody. You buy these things for $300 or $500. But, if they had any value, I assure you, JP Morgan or Goldman Sachs would buy them for $10 billion. So they don't work. And by and large, everybody, comes back to us and says, I've been burned, I've been scammed, I've been this. And, this is the only thing that makes sense to us. So hopefully, this may resonate with you. So I just make the determination of whatever I do exclusively based on the price patterns and price action in the market. Everybody says, do you trade the news? And the quick answer is no. So I'm going to play you a little tape now, give you a little bit of exposure to my trading methodology. I think that's going to be the best way for you to kind of understand that. And then we'll kind of look at the markets and dig into the price action that's going on right now. So Dwight's going to tee up the video, and then I'll come back and talk to you guys.
So at any given time, I have 30 trading instruments on my broker platform. I look at most of the FX markets, the Forex markets, as well as other cash instruments, including gold, oil, and some of the global indexes. But as I indicated, you can trade stocks. So whether you're trading Netflix or Amazon or Apple or whatever stock you might be looking at, or if you're looking at commodity futures, whether it be corn or pork bellies or cocoa, you can apply the same principles of this price action, price pattern trading strategy. So as I indicated, I have about 30 different trading instruments. And at the end of the day, I'm just trying to evaluate the best and the most high probability trade setups for the next trading session. And usually it just comes down to one or two, and then many times I have no trades at all if I don't see an opportunity. And that's where the discipline and the patience come in, but I'll get into that in a moment. So if I open any of my given instruments, whether it be Euro versus USD or Pound versus Yen, the first thing I'm trying to assess is what is the phase or the condition of that market. And by and large, you've been told that there are only three ways a market can be going at any one time. The market can be going up, going down, or thrashing around between a resistance and support zone in a sideways market. But I'm going to add a couple of other nuances. To my mind, the market can also be turning from down to up, or in this case, from up to down. And this is where I consider I have a very large edge, because before these markets turn, they always put on a price pattern that is pretty recognizable. And so even though market participants might, be caught unaware or surprised when a market makes a 180-degree turn like this, the market does put on a look before it does that. And this is where I can, very easily get in, early and capitalize on it big time. Now, if the market is turning, as I indicated, there will always be what I call a historical precedent or chart pattern that precedes that turn. Now, you can consult any number of technical analysis websites or textbooks, and it'll show you many, many patterns. Today, I'm just going to share with you a handful of these chart patterns, and then we're going to look at the live markets and see how there are a number of markets that have turned with these patterns in the rear view mirror. So the first major chart pattern that I want to share with you is what I call the double top or double bottom. And it's just the way it sounds. So this is an indication of prices that were heading up, hit a resistance point, backed off, hit that peak again, and then backed off. And then when it crosses what we call this neckline, which is simply a line drawn through the pattern, it reveals what we call an M top or a double top. And this is indicative of a market that is reversing from a market that was going up, hit this double top, and then indicated a market that was going down. If we look at the euro versus British pound right now, we can see that it made a double top in the late November 2016 timeframe, and I was able to successfully short that in the recognition of this price pattern. On the other hand, this is a market that was headed down, made one trough, backed off, retested that area again, and then successfully went the other way. And when we look back, it looks like a W or a double bottom. And the Australian dollar and the New Zealand dollar versus US dollar all have the same kind of looking W bottom patterns on the weekly charts right now, which may be indicating a higher move in the future course and trajectory of those pairs. This is a head and shoulders chart pattern, and it's just the way it sounds. So this looks just like a man or woman's head, left shoulder, right shoulder. And when we cross a line through the entire pattern, it's called a neckline. And I'm going to show you the weekly dollar yen that I recognized this head and shoulders pattern at 124 and was able to short that market all the way to 100 in the dollar yen recently. This is an indication of just the opposite. It's called an inverted head and shoulders, and it's just an upside down version of this head and shoulders, which indicates a market that is reversing from a market that was going down. When it completes this inverted head and shoulders formation, it then indicates a market that is going to shoot out the other way. This is a number of different triangles. The first one is called an ascending wedge triangle. It's denoted by a sloping uptrend line against a horizontal line that connects the highs. And when we look at the dollar Swiss franc or the dollar Canadian, we see that this kind of ascending wedge triangle is being traced out while we speak. On the other hand, this is what we refer to as a descending wedge triangle. And I'm going to show you chart after chart that is traced out exactly a bear looking triangle pattern like this. This is typically indicative of a market that was going up, and then when this pattern or this triangle is completed, it indicates a market that will inevitably crater or go much lower once it completes this triangle. And again, I'm going to show you today a number of descending wedge triangles. This is just a fancy version of the double bottom. It's called a cup and handle, where we see the cup and the handle. These are a number of different channels. If we see this at the top or bottom of a market, it's either a rectangle bottom or a rectangle top. We see that the euro pound broke out of this many months ago. The dollar yen broke out of this on a daily basis not too long ago. And these are just a variety of different channels that we see in the market all the time.
So once I understand the phase or the condition of the market and or a chart pattern that suggests a turn, I don't arbitrarily wade into the market. I wait for what I call an insurance day bar. Now, that's my cute little phraseology for a bar that puts me in the momentum of the trade and also tells me exactly where and how to assess my risk. So this to me is the holy grail of trading, where I can hop on a trade when it's the right time to enter, and I can also know how to apprise my risk. So what exactly is an insurance day bar?
So again, this is a layered approach. One step confirms the other. And so just because we either identify a trend or a chart pattern, we don't just simply wade in at the market. We wait for what I call an insurance day bar. And this is kind of my own little personal slogan for this particular bar. And the reason why I've called it an insurance day bar is because when we see this particular bar, it actually isolates exactly when the momentum is likely to continue in our favor, and also tells us where and how to place our risk. So what exactly is my definition of an insurance day bar? Well, the first definition is what I call a key reversal. And a key reversal is exactly what it sounds. So this is representative of a market that was stair-stepping lower, point where there are no more sellers, and then reverses 100 miles an hour and closes in the opposite direction. And when we see these reversals, very often this is where the market is pointing to where it wants to go. So we don't have to be geniuses with an MIT degree in economics to know when these market reversals are happening. The market actually tells you the direction where it wants to go and when it wants to go when we see these. This is another example of a market that was going higher, hits a point where there are no more buyers, reverses and closes on the opposite end of that daily bar. And of course, the larger the bar, the more robust an indication of that signal to come. And again, this may be, depending on where this reversal occurs, maybe a signal that the market is pointing exactly where it wants to go by closing in this kind of reversal fashion. So again, when we see these key reversal bars in context of a trend or in context of a chart pattern, then we have the beginnings of a high probability setup. Now, my second definition of an insurance day bar is what we call an inside day bar or narrow range day bar. And it's just what it sounds like. So this is an example where the high and low of this particular bar, this daily bar, each bar represents one day, sits within the high and low of the previous day. And you'll also notice that the range from low to high is much smaller or narrower than the preceding ranges of the preceding trading sessions. So this to me represents a coil or a storing of energy. And the metaphor I always use or comparison is a beach ball effect, where picture, if you will, you suppress a beach ball underwater, you keep pushing it, pushing it, pushing it, and then you take your hand away. What happens? It just explodes to the other way. And this is exactly what happens when we see the presence of these narrow range or inside day bars in the market. Now, I recognize you're just looking at a cartoon on a page right now, but I'm going to show you under live market conditions how the markets explode out of these coils all the time. This is an example of a key reversal and an inside day bar where we have this coiling effect, this beach ball effect. And then when we have a release of this energy, we can expect this kind of movement in the market.
Okay, so now that we've done a great job of identifying the phase or the condition of the market or a chart pattern that suggests a turn in the market, now we've waited for our insurance day bar in the form of a key reversal or an inside day bar. All of this is basically our subjective analysis. Ultimately, we want all of this analysis to be confirmed by the market. And the way I do that is by placing a pending or resting order outside of the daily range.
So as I said, this is a layered approach, and each step confirms the other. So even though we might have confirmed a trend or a chart pattern indicating a turn in the market, then we see the presence of our inside day bar or key reversal bar, insurance day bar. Then we wait and layer it all with an execution plan in the form of a pending or resting order. So effectively, the pending or resting order requires the market to ultimately confirm our entry point. So up to this step 4, all our analysis, whether it's our analysis of whether we're in a trend, whether we're in a reversal chart pattern, whether we have our key reversal bar, whether we have an inside day bar. This is all our own subjective analysis. And we can be right and we can be wrong. But the market is never wrong. The market is always 100% right. So by using this execution plan, we require the market to confirm our entry point. And then also this resting order also puts us in at exactly the time that the market is ready to go in our favor. And let me show you exactly what I mean. So this would be an example of, let's say we've identified our insurance day bar in the form of a key reversal, where the market opened lower, as indicated by this slash mark, and then went higher and then closed on the high of the day, within, again, the context of a trend that's going higher or a chart pattern that indicates this market is going higher. And now we're interested in taking a position on the long side. Again, I don't just arbitrarily get in when the market closes for the past session. I put in a buy stop, resting order, or pending order just above the previous session high, usually by about 1 or 2 pips. So I'm not going to go into a huge explanation of buy stops or sell stops. You can go to your execution orders in your MetaTrader platform, and you can see a buy stop and sell stop there. But effectively, we place a buy stop above where the market is currently trading. In this case, I typically place a buy stop 1 or 2 pips above the high of the previous day's range. And then I put my sell stop just the other side of the close or the unchanged of the previous day's bar. So 2 scenarios can happen once we place our buy stop. The first is the market opens for the next session, drifts lower, and then never recovers. It just keeps on going down, and our buy stop is never triggered. Then I simply just cancel the buy stop 24 hours after I place it, or roughly just before the start of the next session. The other scenario is the market opens, goes lower, and 1 hour later or 2 in the morning while we're sleeping, our buy stop is triggered. And now we're placed in the market at the time and place where hopefully the market is ready to go in our favor. And now we just want to see, obviously, the market to keep going in the direction that we've analyzed it to go. What we don't want to happen is the market goes higher through our buy stop and then starts drifting lower. And then at some point, if it drifts too low, we're going to want to protect our account. And that's why our stop loss is just placed on the other side of unchanged. So again, the stop loss is a bit of an art. It's not a science. What we want to do is not place our stop loss too close to where we might get prematurely stopped out only to watch the market go in the direction we were hoping, but not too far where we're exposing ourselves to too much risk. And this is what it would look like under live market conditions, where hypothetically we've isolated our key reversal, which is now pointing in the direction higher. It's now been complemented with this inside day or narrow range day bar. Now we look to probe the market in the form of putting a buy stop 1 or 2 pips above this inside day bar high, putting our stop loss on the other side of the unchanged, and then hopefully looking for the ensuing market action that looks like this. Now, I recognize a lot of you are going to have questions about take profit and things of that nature, and we will get all of that today or in tomorrow's session. This is an example of an order where we may want to probe the market on the downside, where we have a daily bar where we open higher, plunge lower, and then closed on the low part of the bar, indicating an opportunity we may want to get in on the short side. But instead of just arbitrarily going short at the next session open, we place our sell stop 1 or 2 pips below the low of that session bar. Again, we're looking for the market to confirm our entry order. And if the market keeps going higher, our entry order is never triggered. No harm, no foul. We just cancel it the next day. Similarly, we put our stop loss just the other side of the previous day's close or unchanged level to protect our account. And this is what it could look like under live market conditions. And again, I recognize this is a cartoon on a page, but I'm going to show you time and again where I implemented this kind of discipline and made hundreds and hundreds of pips by articulating market setups just like this.
Okay, guys, so I hope that was somewhat helpful. And so now I'm going to kind of just show you a little bit of how I apply all of that under live market conditions. Before I do so, I like to be fully transparent, show you exactly what I'm doing. So I, started the Pattern Trader to give back, to educate people, but at the heart of it, I am a trader. I trade every day. I love trading. To me, it's a constant challenge. And so whatever I'm saying, believe me, I am doing. And this is not a demo account, right? So I don't even know how you could mimic this if you wanted to under demo conditions, but this is my live trading account. I came in today short Airbnb. Airbnb, let's see, it was down about $9 today. I came in short, well, actually I shorted Coupa Software at about 95 bucks. And right now, if you look in the live market, it's trading at $65. So this thing dropped 30 bucks in about 5 minutes. So I literally made $50,000 in 3 minutes. So what happens is these companies announce earnings and then they move up or down. So you can see that I shorted Coupa Software. You can see I shorted at $92. Then I shorted more at 89.5. And then I covered in the aftermarket at $74 and $73 respectively. So, and that was, I jumped the gun. It is trading at $65 now. So I could have hung out and made another 25 grand, but I made 50 grand in about 2 minutes. So I figured I'd just jump in and take it. But, there's always this constant discussion as to whether technical analysis works. And maybe this will answer a few of those questions, because to me, the markets are completely about technicals. I listen to these analysts all day long. They're, consistently wrong. They sound very intelligent. They can break apart these things and sound like they're talking very rationally, but it really comes down to price and momentum. I also had CrowdStrike. I came in short CrowdStrike. I made about 10 bucks on that, made about 30 grand on that very quickly. And now I've had a big position short Tesla. So I started shorting Tesla last week. I'll show you my average price around $844. And I'm still short this position. So I had about, $2 million involved in this thing, about $1.7 million short Tesla. And, I'm not just doing that on a whim. It's, based exclusively, on my analysis of price action. Tesla's trading about $4 lower right now that I can see in the aftermarket. So these are my open positions right now in Tesla. I started shorting it last week at $853, $849, $851, some more at $846. Today I sold a little more at $784, and right now it's trading about $762 in the market. So based on average share price of about 844 bucks with 2,400 shares short, I'm up about 190 grand in this position. And again, this is not a demo account. So this is real as a heart attack. So whatever I'm telling you, believe me, I am doing in spades. So I started to talk about this prospective implosion in Tesla all the way back last November. So this email, and this is what our emails look like that go out to our elite members. If you're interested in that program after this 4-day session, one of our team members will contact you. I'm not going to try and sell you on anything, these webinars. You don't have to be worried about being bombarded with any kind of sales pitch. Whether you want to do this or not, it's entirely up to you, but I'm just showing you what I do. So what I try and do is educate our members, show them what I'm looking at. So you can see this was very early on when I became very convinced that Tesla was in the process of turning around. This was when it was at $1,200, and now we're at $760. We're $500 lower than where we were when this email went out last November. So this was November 2021, and this should have been a sell stop. So it says buy stop, but it should have been a sell stop. This was another example to sell at 1,017. This was in January, where I said recently this has formed a head and shoulders bear price pattern, and you can see that price pattern there. And Then I said, to sell short at 900 after the pattern became more mature. I said, Tesla's formed an even atom double top on the weekly charts, and I'll look at that. But all of this cumulative price action going all the way back to last October, where I was talking about a parabolic implosion in Tesla. And, now we see that prices are $500 lower. And I guarantee if we meet 6 months from now, it could be $500 lower from here. So this was a setup in the pound versus New Zealand dollar, buying at 192.77 based on an inverted head and shoulders. Then I bought some more at 199 and made a whole bunch of dough on those trades in pound New Zealand. This was an entry in a stock called QuantumScape. I started telling our members to short QuantumScape since it was $70 and now it's $15. So this particular entry was at $40. And then this particular entry was around $30. And, I just been making all this dough on the way down. This was about a year ago where I advised our members to buy the stock of Lyft at $45. And then I said that I'm also long the $46 call options. A call is basically a leverage bet on, something going higher. And so, unfortunately, these broker statements don't do things as neatly as, on FX trading platforms where they present, the buy and sells neatly. So these were all the buys where I was buying this stock of Lyft, 45.60, 45.20, on and on. And I made about $90,000 in the stock. Then I bought these $46 call options for 92 cents. And you can see I sold them for $7. So I made, about 800% on those things in about 4 days. And then I bought these things at $1.10 and blew out of them at $6. So that was about a 590% thing. So all in all, I made about $250,000 in about 8 days on the stock and option in Lyft. This was a bear pattern that I saw in the NASDAQ about a year ago, where I was looking at on the weekly chart, this ascending broadening pattern, which is something that is going on right now. And I put a big leverage bet. I bought these put options. A put is basically a bet on the downside of a particular instrument. I bought 350 of these NASDAQ puts, and you have to multiply it by 100. So this was effectively a $35,000 bet that had to work in a week. You can see I put these on February 19th and they expired 1 week later. So I had one week for this thing to work. 2 days later, those $1 options went to, I got out some at 585, some at 575, some at 6, and some at 8. So I made, 800% on some of those options. And so that 35,000 went to 195,000 in 2 trading days. So this was my most successful trade last year, where I've been very bearish. The stock of BYND, when it was at $200 all the way up here, I told our members that it's going to be a $30 stock. And this week it entered the 30 handle atmosphere. So, but these things move in cycles. In this particular juncture, I sensed there was a trap, even though I thought it was going to go lower. By virtue of the price action, I said that there's a bear trap here. I suggested buying this thing at 120 bucks. I bought the stock. I bought some of these options at about $1, and they went to $23. So you can see the stock I bought at 520. I bought these options at about $1. At this time, they were trading at $15, and I was making cumulatively, 477,000 in the stock and the options there. And then I bought these options for about $1.50. They went to $23 in 2 days. Beyond Meat went from 120 to 160 in 3 days. And I got in early and, actually made a very successful bet on that. So on and on. This is exactly what I do over and over. I go short, I go long, and I know nothing about the companies. I know nothing about the pound New Zealand. I don't know what central banks are doing. I don't care what Jerome Powell is doing. I don't care that there's a war. Not that I don't care. There's a humanitarian crisis and people are losing their lives. But I don't base my investment thesis, whatever Putin's going to do or not do, whatever the US is going to do or not do. I only look at price action. And, I sit here all day long. I'm bored. I've got this, TV news channel in the background. I hear these prognosticators all day long. Everybody's looking to buy it. Everybody's looking at dips to buy. And I have just been actively shorting the US stock market and a lot of stocks, in the stock market. I'm trying to find some emails here where this was an email that went out, I think in late, I don't have the date here. It was in late January. I said since last February, about a year ago. So there was February 2021. I was telling our members to short Peloton, short Zoom, short QuantumScape, short Beyond Meat. And all four of those stocks are probably down 80% from the time that I was alerting our members to short this, despite the fact that everybody's telling you to, buy the stock market. So I said, basically this was, in late January. I said, since last February, I've been alerting our members to a brooding storm across all asset classes. So the NASDAQ was just down 12% at the time. Now it's down probably 25% from the highs. I said, is the selling over? And I said, in my opinion, the answer is hell no. And so I think this is just the beginning of the selling. And this was 2 months ago. And, I was talking about we are in the, vestiges of a late stage asset bubble. And, we're starting to see cracks and fissures in mega cap stocks. So this was before, Facebook tumbled, Netflix had tumbled in a single day, 22%. Now Netflix is down 50% from its highs. And so I've been consistently saying, I said, short the QQQs or this IGV ETF. And, I'm sure we have many members on here who can corroborate that. I've been saying, short Etsy, short Roblox, short Upstart, short Beyond Meat, short Roku. And these stocks have fallen, 50% since January, right? So this is the IGV ETF. And I had a projected price of 260 2 months ago. And I'm going to talk about that in a moment. So this is what my emails look like. I was saying again at that point, sell Tesla. I said I'm short Tesla at 983, 935. Now we're at 760. So I said, to my mind, Tesla represents the mother of all speculative bubbles. And I said, when this parabolic move goes pop, there will likely be a devastating move lower. So I've been saying this for weeks and weeks and months, pretty consistently. And again, it's not just based on a feeling. I, look at everything based on the price action of the assets that I'm looking at. So I guess I've talked a lot about Tesla. So I'll basically go and share with you what's going on there. But so this is the price chart of Tesla. We've all heard this, famous automaker, run by a very charismatic leader. And based on the charisma of this leader, people have just mindlessly just gone into a stock. And to me, this is what I think going to be a parabolic implosion. What is a parabola? A parabola is when prices go up very geometrically. So typically, if you get a sustainable move, you want to see that, go up, bit by bit over years. This has gone up very quickly. And I always, make the analogy to, we've, all seen those air shows where you see these, propeller, acrobatic air, airplanes, go straight up in the air. And then all of a sudden you can, hear the motor giving out, and all of a sudden the motor just cuts out, and then it just starts dropping back down to the planet. And I think this is, what's going to happen to Tesla. The more things, go higher in a very quick manner, they tend to come down equally as fast. And so again, this is not just based on a feeling or, whether I have a gripe or whatever. It has nothing to do with that. I'm basically looking at very empirical chart patterns. So right there, we have what's called an Adam and Eve double top. And an Eve and Adam double tops characterized by when you have multiple attempts at one resistance area, as you do here, and then you have a single attempt at that resistance area there. But, whatever you want to call it, and even Adam double top or what have you, this is a double top. And it's very simply, just like the patterns that I showed you a moment ago, is where a market goes to one high, backs off that high, retests the high. And when you look back, you have a very clear M top. And this is a reversal pattern. And a reversal meaning that leading up to that pattern, the market's going higher. And by definition, a reversal means that it's going to reverse and go the other way. And so we have a very clear and distinct double top. Now, the only thing is, the markets, are like magicians. It's like a magician never just comes on stage and pulls a rabbit out of the hat. It always does, he always kind of distracts you with his one hand while he's pulling the rabbit hat out with the other hand. And so, it's very conceivable that, Tesla could continue to kind of, back and fill, and, it could even go back to $1,000. I don't think it will by now, but, I wouldn't rule it out. You could have a move up here and it still roll over and go lower. So this tells me an absolute top has been built. How it kind of goes lower, that's always the fun part. But to my mind, once I understand what the dominating or governing pattern is, then I know how to set up, my trades going forward. So when I say a governing pattern, to me, this is going to govern and dictate prices going well into the future, weeks, months, maybe even years, so that every time, Tesla goes higher, I'll know that that's pretty much a fake out, and then I'll be looking to, go short. So this is, how I look at, this price information. Now, one of the other things that I'm starting to look at on all of these charts, you've had this very long-term price trend. You can see how neatly, prices have, held, in this area. Every time it comes here, it holds. Now, one time it broke through, then we snapped back. So we had a, bit of a bear trap here. And you wonder, if that was just trapping people below this thing. And now you can see we're coming back down. And, not if, but when we take this out, this will definitely confirm that this move is on. So what's happened is last week we had the first weekly close underneath this long-term trend line. So you can see that last week we closed, this is this week right now. So last week was right there. And that was the first close underneath this long-term trend line. Now we're starting to see Apple and Microsoft and some of these mega cap stocks starting to test this trend line. And so this to me is very dangerous. People are, talking that, things are overdone. This is a great buying opportunity. Frankly, this is just starting to me. This is just starting to break this long-term trend line. And then we have this in the background. So to me, there's still something in the background. Now, you often hear that these analysts, you'll hear these analysts say the S&P's gone from a 23 multiple to 18, and it all sounds very reasonable, and it sounds like, it's corrected and things are sizing up now. But to me, the market is always right, and I only look at the price action. So, a PE multiple is price over earnings, right? And so they're saying the multiple is like 18. That means that price is 18 times earnings. But what happens if the E keeps going down? Then the P's got to keep coming down too. And that's what's happening. And so what can sound reasonable, to me is just fanciful, right? So people were talking about Facebook as being one of the most reasonable of the FANG stocks. So, Netflix, Amazon, Google, Apple, Microsoft, Facebook was positioned as the most reasonably priced. So, up here when the stock was trading at 320 bucks, the PE multiple was around 20 times earnings, 22 times earnings, when Apple was trading at 32 times earnings. So you hear that and you go, wow, Apple's at 32, Facebook's at 20, that's got to be a good value. And when you listen to analysts talk around this period, everybody was buying Facebook. And, I run a morning session called the Boiler Room. And the Monday before earnings were going to be released on Wednesday, I said, you have to get short Facebook. This was when, Facebook was north of $320. Now, at that time, I actually bought these out of the money puts. I bought the 320 puts that had $3 days to expire for $5. And when the stock was at $320. So I needed a huge move for that to pay. And you can see that my $5 went to $80. I made 16 times my investment on that move. So I was telling everybody to short Facebook at the time, where most analysts were telling you, oh, the PE is great, and on and on. Now, whether you know anything about investments or not, Facebook is an institutional, is one of the top 5 institutional holdings. This is a stock that's held by sovereign wealth funds in Dubai. But when you look at this and see this has got to, wake some people up. If you're holding, investments in the stock market, this, to my mind, is indicative of something that is very wrong. So, the markets are a discounting mechanism. The markets are ahead of events. So people always say, do you trade the news? And no, to me, price is the news. We don't know why, Facebook was here when it was up there. But price was starting to tell you. There were all kinds of patterns that were starting to tell you that price was going to drop. And then, we have no idea why. And I think, again, there is something wrong. This market looks very broken when you see stock after stock. This is Netflix, right? This was $700. It's now $350 in just a few weeks. So, investors who've been holding on to this stock for years and years, this is what's called dead money. So, in whenever this was, July of 2020, you're talking 2 years ago, people were investing here, and now the stock is less than where it was 2 years ago. So this is what's called dead money, where people are sitting, and they got no return, actually got a negative return. But when you look at this thing, this whole thing is a double top, head and shoulders. And this is Netflix, NFLX. And you can see it sitting on this downward trending, downward sloping neckline. And to my mind, Netflix is going to go 50% lower than this. If you measure just this neckline, which is simply a line drawn through the pattern to the top of the pattern from 330 to 700. So my math is really bad. What is that? $370. Take half of that and drop it off here, and you have a $150 stock. And so, you'll hear all day long everybody saying it's a buying opportunity, this, that, and the other. There's no recession. The markets are telling me there's something very wrong in the markets. And so this is what I pay attention to. I don't know what the Fed's going to do on Wednesday. We have a Federal Reserve meeting, and they pretty much told you what they're going to do. They're going to raise interest rates, 25 basis points, a quarter of a point. And so the market really knows what it's going to do. But this is going to be, I think, one of the most consequential interest rate statements because of where we're at in inflation with the war and all of the background. And to my mind, I don't watch what the news is. So whatever the Fed says on Wednesday, I'm not going to be listening to what they say. In fact, I'll just turn the volume off. I'm going to be watching, how does the market respond to this news? And so I always look at how the market responds to the news. And it's always interesting, in a bull market, bad news will come out, the market will sell off, and then it'll always go back in the trend. And it's the opposite in a bear market. So now you're in a bear market. And so, some bull news could come out, and you might have a spike that's, a huge spike, but then it'll start coming back down. So to my mind, I've been telling our members for the last 3 months, this is, this has been 10 years of buying the dips, where there's been an ongoing programming. Every time the market comes off, you were rewarded by buying that dip, and then it went on to make a new high. Now I believe it's sell the rally. So every time the market rallies, I believe you should sell that rally. And so this is what I've been doing, and making an awful lot of money doing that. I'll take you to one other chart, and then again, I don't want to have million requests to see charts. Really, what I'm trying to accomplish in these few days is basically show you a way of looking at the markets. So we can go through thousands and thousands of charts, and that's not what I'm going to do. I'm trying to convey a way of looking at things where you can make independent decisions. You don't have to rely on people on internet forums. You don't have to rely on rumor. You don't have to rely on analysts. The market basically lays out a picture and tells us where it's going to go. So one of the charts that I've been looking at that to me is a leading indicator of where the overall market is, this ETF called the IGV. And the IGV is basically an ETF that is technology and software exclusive. So it has companies like Microsoft and Intuit and Salesforce and the big guns of technology. And to my mind, technology is what's led this market higher, and technology has been the first to crater. But before I do that, maybe I just thought I would share with you. I love movies. To me, movies, art. Life typically, imitates art, and there's a lot of truth in that. So I just want to share with you just a clip from an old movie. I was a Sylvester Stallone fan and what have you, but just kind of relevant to. Just going to play this for you.
You may find this hard to believe, but all this is for you.
Hey, Mark, we're not getting the audio on that.
SAT's monitoring devices you see here, you'll be issued every up to modern piece of equipment we have and ensure your safety.
Hey, Mark, we're not getting the audio on that one.
But we have the most advanced weapons in the world available to us. And that the mind's the best weapon. Times change. Some people.
So, look, I'm a dinosaur and a fossil, and, I've been watching this. Sorry, I think I need to turn this off. I've been watching this, technology boom along with everybody else. And, everybody thought that, technology was going to solve all our problems. And, it's, certainly as an asset class, it was going to be, the way to, ever increasing riches. And from what I'm seeing now, technology is about to get routed. And, we've been so rewarded with technology that, I think we're conditioned to think that this is just kind of a minor blip. But I think this could be, something much greater. And so, I don't know if you could hear that movie clip, but basically, they were telling Rambo that, he was going to go into the jungle to find these prisoners of war, and they had all this technology that was going to help him. And his response was, I always thought that the mind was the best weapon. And I continue to believe that, and so I think that you can use technology to trade. So there are all these what's called expert advisors. You can go find them on the internet. They'll sell them to you for $300 or $500. And, they'll say you just load them up on your trading platform and they'll just trade for you infinitely. And, they'll be able to navigate the bear markets, the bull markets. And, again, if that were true, they would be selling a lot more than, for $500. So, I just advise you to use your common sense when you look at that. But to me, I just look at things visually and make decisions based on the representations that the market is telling me. And what I see is the convergence of two patterns, two very bearish patterns in this. Remember, this is the IGV. It's a technology ETF. And it doesn't really matter what the instrument is. So you can use the same analysis to look at corn and natural gas and gold and the euro versus the yen. It's the same thing. So when I look at the IGV, and I was calling the turn right up here, I said, this thing is about to turn much lower. Now, why did I say that? How did I know? I don't have any special inside information. I was just looking at a very conventional pattern that was forming in the form of this head and shoulders. So it looks just like a man or woman's left shoulder. The peak is the head, and then you have the right shoulder. So it just looks like this. Looks like a head and shoulders price pattern. But whereas this has a horizontal neckline, which is a neckline is simply a line that's drawn through the pattern. This has somewhat of a downsloping neckline because the left shoulder sits below the right shoulder. The right shoulder sits below the left shoulder. So we have a bit of a downsloping neckline. So what that downsloping neckline informs me is that not only is this bearish, but it's likely to go down very, very quickly. And that's what you saw. Once this broke this neckline, which it confirmed right there at 380, it's been a straight bus ride down to 302. So I don't know what that represents. It's like a 25% move. So if you just understood that pattern, you could make 25% by just shorting this ETF. And this is what I've been advising our members. I've been buying puts on this IGV all the way down. Now, as I said, this bear pattern in and of itself is enough to inform me that this thing looks very ugly. But you have now the convergence of two bear patterns, where the second is you draw a line through the tops here, this resistance line, and then you draw a line through the bottoms, and you have this what's called an ascending broadening triangle, where throughout this pattern prices are ascending. It starts out life in the pattern narrow and then widens or broadens out at the top. So it's called an ascending broadening price pattern. But whatever you call it, this is a negative or a reversal bear pattern. And you can see that both the neckline of the head and shoulders and the lower support line of this ascending broadening converged right at the same place. So this effectively was the starting gun for this bear market, right at this 380 price line. And I was saying as much, when this was occurring in January. And I was looking at this ETF and, saying to our members that you should look at this as a proxy, because this is telling you where, things are going and likely to go. So every day you'll hear most of these analysts saying we're getting closer and closer, to valuation, where this is a buying opportunity. And to me, for this to fulfill its objective, usually when we see the ascending broadening triangle broken and confirmed, this is like having next week's or next month's newspaper. I kind of know where it's going to go, because to me, it has to go back to where it started from, to the origin of that pattern, which is around the 260 or 270 price level. So you can see that we're not too far away now, maybe 10% or so until we come in touch with this. But typically, bear markets could also overshoot. So there's, every possibility that we could go still lower. But to my mind, there's still, meat on this bone. There's still more downside here. And, but that's not to say that you can just passively wade into these things. There's a way I approach every trade. I showed you my 4-step trading methodology, where I wait for an objective price action, what I refer to as my insurance day bar. And you can see this is a weekly chart where each one of these price bars represents 1 week in time. And so to my mind, there's two forms of an insurance day bar. One is the key reversal, where market makes a new low, makes a new high, closes on the low. And the other is what we call an inside bar, where literally the price range from high to low sits within the high and low of the previous day. And if you look at this chart, you can see there was let me just grab the right drawing tool here. You can see right here, made a new high, closed on the low, and it went lower. Then a couple of weeks ago, made a new high, closed on the low, went lower. And so these bars in context, so I don't just look at these reversals and say I'm mindlessly gonna, every time I see a reversal. This is in context with the bear pattern, the bear trend, and I just wait for a certain opportunity where I can understand the risk and reward. Now, sometimes things get a little hairy where, you can't just mindlessly just say, okay, Mark said this is going to go down. And so now you just sell it here. And because you can have all kinds of, upside. So, the thing about markets that go down, the short covering rallies, when, markets just find a level to bounce, can be enormous. So those are 10, 15% bounces. So you can kind of get here, get into an air pocket and find this thing goes up 10, 15% very, very quickly. And, I wouldn't be surprised on Wednesday that maybe the market, discounts certain things, or, it's overdone to the downside. So you have to be very calculated about how you set up your trades. You can't just, getting in here where I can understand. So if I see this key reversal, I know I can put a sell stop there. I know where my stop loss is. And so I can kind of understand my, my trade from there on. Once this trade starts, moving, then the risk reward dynamics become much more complicated. So people always ask me, where do you put your stop loss and take profit? And that's a very complicated discussion, only because, once the thing starts moving, then the risk reward calculus is very different. So to my mind, my best trades are when I understand exactly when to get into a trade and how to calculate my risk. And so I'll just give you this example, and then I'm going to leave you now because we can look at this, endlessly. This was my trade for tonight to our elite members. And this will kind of give you an insight into how to, find a trade where the risk reward, is a little bit more understandable. So the first of all, I always look at a high level, what's going on with this chart? Is it going up, down, or sideways? Well, to my mind, this is in a downtrend. Is there a pattern that dictates the behavior? To my mind, you have this double top here, which to me is the governing price pattern. You have this head and shoulders. So you have this downward trending thing. Now you're at the resistance level. You have this key reversal right here. And then today you had this inside bar. Now this is a little bit tricky where, I basically said you can, put a sell stop here. But, I could easily see where, things come and retest back up here and then come back down. But so this is a stock called SGen, SGEN. It's a genetics. But I do believe that you have a top here, you have a coil, and this thing is probably going to roll over lower. And so what I try and do is find where there are pockets where I can identify a risk reward, where, again, what I try and do is identify where I can find something that, is likely going to be 2 or 3 times, the outcome is going to be 2 or 3 times what my risk is. So if I get in here, this is likely my risk, that would be the reward. And so I'm always looking at a risk reward relationship, in my trades. And then once the thing starts going, then, the profits just keep accumulating and I will just keep holding it. So I've been in Tesla since 844. I've been in this trade since right here at this area. And, now it's, $80 lower. And now, it's likely going to come somewhere close to, this support area, this week or whenever. And so I look to get in at, certain areas and then ride that trade and capitalize on big moves in the market. So I'm not necessarily looking to day trade. I don't have any particular time frame. I'm just looking to take, chunks out of the middle of a market. So if a market's going to break out here, I want to take a piece of the middle out of this, and then if I see a reversal here, I want to take a piece of the middle out of these kind of trades. And so this is what I'm looking for, is taking a piece out of the middle out of big moves. What I'm not doing is trying to micromanage and be in and out of the market 5 times a day, try and take $1 or $2. I'm trying to take $30, $50, $80, $120, maybe be in a ride where this thing goes down $200, $300. And so this is the objective that I'm looking at. So if you have any comments or any questions on the methodology, please don't ask me to kind of look at, more and more charts. Really what I'm trying to do is convey a way of thinking, a way of looking at the markets where I don't know how many cars Tesla is going to make this month or this quarter or next quarter. I don't know what his cash flow is. I don't know what his balance sheet is, and I don't really care. When I look at Tesla, I just see a series of bear price patterns. So right here, you kind of have this island top right up there. So whatever you want to look at, it's a double top. Here's a Head and Shoulders. Here's a double top and a Head and Shoulders. Here's a double top and a Head and Shoulders. And so this whole thing up here is what I call a distribution pattern. People are getting out. They're handing it over to uninformed retail traders. So including Elon Musk, who dumped about $16 billion worth of stock up here. So this is a distribution where people are getting out and handing it over to retail investors. And eventually, I think this thing is going to turn much lower. So what I do is I look at these patterns, and this informs me what to do. I'm not looking at the projections. I don't care how many cars it's going to make. I don't care that EV is the future. All I'm looking at is price patterns, price action, and risk and reward relationships. Ricardo says, how do you measure the target after you've made a Head and Shoulders? So, there's some loose ways of kind of measuring a trade. So, you have a double top here, call that the neckline. So, this would be kind of measuring the carpets and the drapes. So the neckline would be about 875 to the top here, which is about 1,200. So call it $300. So I would just say, let's take 70% of 300, 200, and shave that off that neckline. And that brings you down to, what's that, 870, 670. So, and that's exactly where we kind of came to there. But, I think we're going to go a lot lower. So I would, take $300 off this neckline and say that we're going to, at least, 570 here. And I think this could be a $300 stock. If you told me this was a $150 stock, I wouldn't say you're insane. I think this is going to go lower and a lot lower. And when it starts coming apart, it's going to come apart quickly. So please, if you have any questions about the methodology, please, confine your questions to price action or things of that nature. So Yoel says, I trade gold. So will it be talk about gold? Again, you can apply this analysis to any trading instrument. So I'm going to, we're going to be together 4 days. I'm going to be looking at a lot of instruments, showing you how I apply, this kind of logic and methodology to different types of trading instruments. So, Casey says, does Mark short stocks or mainly buy puts? I do both. There's a time and place to do one or the other. The puts have become very, very expensive because as the volatility goes up, and the volatility has been incredible in the markets, we're seeing 1% volatility an hour in the indexes. There was a Thursday a couple of weeks ago in the NASDAQ where it opened down 3%, then went higher by 3.5%. So the whole day it moved 6.5% in the day. So that's just on an index. And individual stocks are moving 10%, in the day. So, I sold Coupa. Where's Coupa? Where is this thing? Right here. I sold this thing, at, half an hour before the market at $94. I went short, and now it's trading at $64. So there is a lot of volatility. You can see Tesla close at 766, it's trading $4 lower. So there is a lot of volatility in the market. So when the volatility expands, the options are very, very expensive. So it makes it a very dicey thing to trade options. So, I have a whole different way of trading options. Jeff says, after the Head and Shoulders forms, are you then looking for key reversals for entry? So exactly, Jeff. So you're exactly right. So, once I understand the trend, then I look for all of the ways to get in that trend. So you're spot on. So once I kind of understand what the drill is, and, I see all of these bear patterns, then I'm just looking for ways, to get in the market. Right, inside day bars, key reversals, things of that nature. So, right here you have a series of, key reversals, makes a new high, close on the low, makes a new high, close on the low, and it tells you it's going to go lower. Then you kind of have this inside bar, which I shorted right there. And then it gave way to, that move. So once I understand what I think the dynamic of the chart is, so to me, this is a chart that you want to sell the rallies. You want to find the spots where, every time this thing rallies, it's likely a fake out. And now you're going to, probably come into this area, and there's going to be a lot of turbulence here. Whenever a market is staked out, a rally, whenever you come here, you could get a monster rally again. So, Wednesday could be a huge catalyst where you could just see enormous kind of, rallies. But to my mind, this is in the books. This is irrevocable. Once these patterns form, there's a reason why they are forming. So that, if I was, going to get a gigantic rally, I'm just shorting into that. And so, but, I'm looking for a way to get in where I understand the risk and reward. So let's say you kind of come back down, you come up, now you see this, key reversal. You see an inside bar, or you see, combination, and you see something like that. So if I see something like this, I'm just backing up the money truck. When I understand, a market's coming down, then I see, a set of, all kinds of, reversals where it makes a new high, close on the low, now you have a double top, and then, you basically can stick your sell stop there and, look for the next leg lower. And this is maybe what we see, where I think it's going to do a lot of gyrations in here. It's really stuck between a, support and a resistance level. We're right in the middle, and you're likely to see all kinds of crap in here. But to my mind, I would just, sell the rallies in here. And, we're going to, go a lot lower. So then at some point, you'll come here and you'll see this and say, well, isn't this a double bottom? And this is where the market throws you a lot of looks, where it starts going up now and you go, well, isn't this a double bottom? And it could look like now you've got to determine which is the governing pattern, which patterns are governing, the next direction. And that is the nuance, so it's very easy to kind of us to talk about something that looks reasonably, simple right now, but then the market will throw you all kinds of looks, and you got to sort through which one is the real deal. And so recently, I was short CrowdStrike coming into today, and this is a good example of, which is the governing pattern. So sometimes we'll get, thrown all kinds of looks. So this is a stock called CRWD. And, recently we saw, what looked like a triple bottom. Then you had a very positive news announcement. The stock went up $30 after the news alert. And the question was, at this point, is this a sustainable rally? Is this a bottom that is going to now lead to a sustainable rally? And I was telling our members, no, I was shorting it up here. Why? Because I believe this is the governing pattern. So here's your double bottom. Here's your funky head and shoulders. Here's your kind of neckline that is. And so to me, this is just a double top, and this thing's just going to keep rolling over. So the market throws you all kinds of crap, and, you got to sort out, which is real and which is bogus. And, I think I do a pretty good job of not only identifying the opportunities, but also the different looks and the traps that the markets throw you. So I think I'm going to leave it there. We've got 3 more days. We're going to cover a lot. And, I will take some more questions tomorrow. Tomorrow, I'll also discuss about how to allocate risk to your trade. So everybody romanticizes, hey, I'm just going to get in this trade and make a whole bunch of money. But very few people understand that trading is all about if you understand your risk, then what the market's going to do after that is, that's something that's out of our control. But we can control and contain our risk. And a lot of people don't understand this. And I'm going to talk a little bit about risk management in tomorrow's session. So with that said, thank you very much. We've got over 300 people on this webinar, so fantastic turnout. And it should be a great week. I mean, Wednesday is going to be rock and roll. 2 p.m. Eastern time. Federal Reserve is going to announce its intentions on interest rates, and I think we're going to see a lot of entertainment. But that's where it really becomes important on knowing how to set up your trades and how to, So to me, it's all about identifying pockets of risk. So so to me, this double top right here, when this was careening up here, I didn't think this was going to get taken out, this 207 area. So now, if I feel like I understand this trade, that this is really the governing pattern, this is a double top here, and now you have a little inside day bar, right? Where that range sat inside of this. So all I did was I put my sell stop right underneath here, prices crashed. And so to my mind, when I got in this trade, I got in here and my risk was there. So this is my risk. And I think this thing could go a whole lot lower. So it's all about risk and reward. If you can risk $5 and make 25, that's how you make a lot of money. But what most people are doing is they're, risking 10 pips on a pair, and they're trying to make 10 pips 5 or 7 times a day. And that's just a recipe for disaster. So I try and set up my trades where the outcome is at least 3 times bigger than my risk. So if I'm risking, $7 in here, and, I can make 14 or 20, that means my, outcome is 3 times bigger than my risk. And that's how you make a lot of money in trading. So I'm always looking to find little pockets where my risk is dialed in. I didn't think it was going to get above this area, and my reward is much more than my risk. And that's what trading is all about. Trading is about understanding risk. And the problem is now, if the market starts moving here, yeah, I said it's going to go down, but if you start getting in here, it's a whole different thing than getting in up here. The risk is much less known, or more, less containable. So to my mind, it's all about waiting for the market to get into these little pockets where you can identify a risk-reward relationship that puts the odds in your favor. And that's what trading is all about. And people really don't understand that. All right. Have a great day, and I'll see you back tomorrow. Thanks, Dwight.
All right, Mark. See you tomorrow.
All right. Thank you.